What if I told you that a tiny narrow waterway that is 34 kilometers wide can affect oil markets and even your forex trades?
Descending toward the Middle East, we see the Earth's atmosphere. This is the Strait of Hormuz. It is a vital gateway linking Iran, Oman, and the Gulf.
If you are trading the forex markets, gold, indices, then understanding the Strait of Hormuz is very important. It's not just for professional traders or those who trade in hedge fund and investment bank trading floors, but for even retail traders like you and I. Today I'm going to be explaining the Strait of Hormuz and why it matters for forex traders, and also the reason why geopolitical tensions from there affect currencies like USD, Canadian dollar, euro, the Norwegian Krone and the JPY. Let's begin with geography here. The Strait of Hormuz is a narrow chokepoint waterway that connects the Persian Gulf and the deep Arabian Sea. Countries like Saudi Arabia, United Arab Emirates, Qatar, Kuwait, Iraq all export their crude oil products through these tiny choke points. Every day, about 20 million barrels of oil passes through this tiny waterway. That is 25% of global energy exports. So imagine 1 out of every 4 barrels of oil is passing through this tiny route every single day. That tells you the importance of the Strait of Hormuz in the financial markets. So the question is, why do forex traders care about the Strait of Hormuz, and why you as a retail trader needs to begin to understand the Strait of Hormuz from today and how it affects your forex trades?
Crude is up 5%! This is bad, real bad! They're threatening to close the strait! Halt all energy trading now!
The financial markets don't wait for things to happen. The market reacts based on expectation. So if there is a conflict or a heightened tension around the Strait of Hormuz, maybe between Iran, the United States or Israel, traders around the world will ask one question: is oil shipment around the Strait of Hormuz going to be disrupted?
Is that situation going to cut off supply? Shipments face real delays.
So even if oil doesn't stop flowing through the Strait of Hormuz, the fear alone causes risk and panic in the financial markets. Uncertainty surrounding the Strait of Hormuz pushes crude oil prices up because traders expect future supply shortages. Remember this basic economic principle: if supply is down and demand remains the same or is up, prices will push to the upside. Now, let's follow this chain reaction for you to understand how crisis or tension in the Strait of Hormuz affect crude oil prices and your forex trades. Now, if there is conflict around the Middle East, investors begin to fear that shipping is going to be disrupted in the Middle East. Crude oil prices begin to rise because there is fear of shortages. And when crude oil prices are rising, airline travels become expensive, transportation becomes expensive, electricity tariff even rise, even food become expensive, and inflation fears begin to creep into the economy. Now, when central bank begins to notice this inflation, which is caused by the disruption in the Strait of Hormuz, interest rate, or maybe delay to cut interest rate, or even increase interest rates. Now, pay attention. This is what matters. When interest rate is expected to rise, investors will begin to move their money into economies that are raising their interest rate, and this is what drives demand for a particular currency, therefore causing the currency to push to the upside. Now understand.
Rate hike approved. Move the capital now. Shifting to fixed income. Let's go.
Upside. Now understanding the domino effects of what is happening around the Strait of Hormuz is very crucial for you to understand which currency to buy and which currency to sell. So before you take action around that order block or supply and demand zone, ask yourself, especially during the geopolitical tension, how will this affect my forex trades?
God, please, not everything. Why did it have to reverse?
Now let's look at currencies that lose or wins when there is conflict around the Strait of Hormuz. One, we start with the Canadian dollar. Canada is a major exporter of crude oil. So when crude oil prices are high, Canada earns more revenue, and that often strengthens the Canadian dollar. The second currency that could strengthen when there is crisis around the Strait of Hormuz is the United States dollar. Now aside the United States also producing some reasonable amount of crude oil, they will earn more in terms of higher revenue because of high crude oil prices. But don't forget that the United States dollar is also a global safe haven currency. So when there is tensions and uncertainty around the Strait of Hormuz, investors will begin to buy dollar, thereby dumping risky assets, and this causes up move in the United States dollar. Now, on the part of currencies that loses when there is uncertainty around the Strait of Hormuz, one is the Japanese yen. Now, even in a period of uncertainty like this, the Japanese yen is expected to gain, but that is where sentiment comes in the financial market, because Japan imports 80% of its crude oil and they come through that narrow passage, the Strait of Hormuz. So when crude oil prices are high, it's a negative on the balance of trade for the Japanese economy. And you can see that on the chart here between the United States dollar and the Japanese yen. So that is why understanding Forex market sentiment is as crucial as understanding your technical analysis concepts. A currency on the losing side as well is Euro. Europe imports large amount of crude oil from the Strait of Hormuz. And when crude oil prices are high, it affects growth because production becomes expensive for companies, and this causes decline in the value of euro. Check for example the price of euro GBP here as it's moving to the downside during the course of this tension between the United States and Iran. Another important asset that is worth mentioning here is gold. Gold often rises during a period of uncertainty, but remember, as I mentioned earlier in this video, that sentiment matters in the forex market. During the course of the recent geopolitical tension between US and Iran, gold prices were pushing to the downside, simply because if the higher crude oil prices is going to cause inflationary pressures, central banks are going to hike their interest rates. And when investors weigh two assets like gold and United States dollar, if the Federal Reserve in America is hiking interest rates and dollar is also a hedge against uncertainty, investors will definitely dump gold and move to dollar. And that is the reason why we are seeing that gold USD was pushing to the downside. And some traders now ask themselves, but gold is a hedge against uncertainty. Now you understand that sentiment matters. So before you take trades or before you do your technical analysis, you need to understand that currencies are moving because of movement and changes in the economy.
Forget the Middle East uncertainty. With the Fed poised to hike rates, we want yields. The dollar's the new safe haven, sell gold.
And now we can see that only one tiny choke point between Oman and Iran can cause massive moves in the financial markets. That is why professional traders don't just study technical analysis alone. They study geopolitics, macroeconomics, and global energy markets. If you have learned something new from this video, don't forget to like, subscribe to the channel, and leave a comment below what geopolitical event you would like me to cover next. See you in my next video. Forex Evangelist cares.